All right. So I started with the introduction of the course. We went through the course overview. Then we talked about QuickBooks and how it will work in the course. Now, let's start with our very first chapter of Principles of Accounting 2, and that is on financial statement analysis. For those of you who are following along at home, in order to find the presentation that we're about to cover, you want to log into the classroom, come to week 1, come down to the instructional materials, click on the instructional materials document, and here you'll find Chapter 17 PowerPoint. You can download this in a lot of different formats, whatever is easiest for you. You can also download it in the original format. Okay. So it's there, or you can just open it up and it's right there in the reader as well. So whatever's easiest for you, but it's there. And then as you scroll down, you'll see YouTube videos related to the chapter, LinkedIn Learning video related to the chapter. And then, of course, where we are right now is chapter 17. So let's go ahead and jump into it and talk about financial statement analysis. I apologize. It does this to me every single time I start a presentation using WebEx. Okay. Hopefully you're ready, because here we go. Financial statement analysis. In business, it is so important to know the financial health of your company. Whether it's a small company, medium, large, you got to know the financial health of the company. For a lot of different reasons, too. It could be you need to take out a small business loan to fund a project or a new operation. You need equity investment to acquire new shareholders. If you do it, what can you do? How healthy is the company? We do that through what's called financial statement analysis. We look at the company in a couple of different ways. We look at it through ratios. We look at it through the horizontal analysis, vertical analysis, and a couple of other different ways. So that's why you'll find this to be very important. So the first thing we need to do and understand is, who are the readers of our financial statements? Why do they care about the financial performance of the company? So to do that, we look at the purpose. The reason why we analyze financial statements is to understand our past performance and our current performance. Okay, how well our sales were in the past compared to now, how much our expenses were in the past compared to now, etc. So from a time perspective, it shows us trends, right? Second reason why we analyze financial statements is because we need to understand the current financial health of the company. How well are we doing right now? Are we at risk? Are we safe? What's our outlook? Those are the types of questions we want to know now. How do we look at it right now? And of course, the third is future performance and risk. We analyze financial statements to understand what we need to do going forward in order to grow, stabilize, compete, etc. We need to know the financial health in order to determine the future performance of the company, forward looking. And of course, risk. We need to understand and make sure and analyze our risk of the company. Okay. How risky is my business if I make these kinds of moves? Yeah. So those are the three reasons why we analyze financial statements. Now, who cares about this? We have internal users and external users of financial statements, as you know. We've talked about this in Principles of Accounting 1. Internal users are individuals inside the business. Okay? This includes managers, officers, internal auditors, other employees, board of directors, etc. Okay? Internal users inside the business. They care about the financial performance of the business because they're the ones making decisions about where the business is heading in the future. Yeah, absolutely. Then we have external users of the financial statements. Shareholders, lenders, suppliers, government entities, people outside of the business, sometimes even customers. As a shareholder of businesses, I care about their financial performance. Why? Because I don't invest in losing companies. I'm not going to go buy shares of stock in Sears right before they go out of business because I, as an investor, knew that that was going to happen. How would I know? I analyzed the financial statements. I looked at the ratios. I looked at their ability to be solvent and realized it wasn't going to happen. So I'm like, well, I'm not going to invest in them. Or, man, I should have bought shares of stock in Google or Apple before they took off. Yeah, we all could have done that. We all should have done that. But we didn't know. Why not? Because we didn't analyze the financial statements as shareholders. Shareholders or prospective shareholders would be interested in performing financial statement analysis. Lenders, the banks. If you're a banker, you definitely want to know the financial performance of the company that you're about to give a loan to, because they might already be in a situation where you might not be able to pay back that loan, which is part of the determination of the interest rate. And of course, your suppliers. As a supplier to a business, yeah, I want to know how well they're doing because I want to make sure I can get paid if I sell them some inventory. So those are just a few reasons why financial statement analysis is so important. There are 4 building blocks of financial statement analysis. We have liquidity and efficiency, profitability, solvency, and market prospects. Who on the call today, in the classroom right now, who on the call today, who can tell me what does it mean to be liquid? What do you think? What does it mean to be liquid?
Isn't it being able to like sell off your assets into cash?
Yeah. Absolutely right, Christy. Yes. Yeah. Liquidity means how quickly we can convert our short-term assets into cash, our current assets into cash. Absolutely. That's what liquidity means. Liquidity is an important measure of how efficient we can generate revenue, sales. Okay, efficiency, of course. Liquidity and efficiency. Liquidity, how quickly I convert into cash. Efficiency, how efficient I can generate revenue. Sales. Yeah. Yes, very well done. Thank you, Kristen. Who on the call can tell me what does it mean to be solvent? What does it mean to be solvent? I don't know if you may have not heard those terms before. Solvent. What do you think? What do you mean be solvent? A strange term, yeah? Oh, no takers? Okay, I'll go. Solvent. Solvency. Solvency is the ability to generate future revenues and meet long-term obligations. That's cute. That's the textbook definition. Here's what it really means. Solvent means the business can pay all of its debt. To be solvent means you can go out of business and satisfy all of your obligations. Solvent. It means all of your total assets will cover all of your liabilities. Yeah, solvent. That's what solvency is. What about this next one? Profitability. What does it mean to be profitable? Profit. What is that? What do you think? What's a profit? Come on, I promise it's not that difficult. Profit. What do you think?
The money you make after like paying your expenses and everything.
Yeah, absolutely. Yeah, you nailed it. It's profitability is similar to net income. Okay, if you remember the income statement has revenues, which are sales, and all of your expenses. And at the end is what we call net income. It's your sales revenue minus all of your expenses equals net income. Okay, you remember that from Principles of Accounting 1. Profitability is similar to net income because it shows the ability to provide financial reward to the company and to attract new investors and retain financing. Fancy term for saying net income. Yeah, that's profitability. You're generating a profit. Your sales are greater than all of your expenses. Yes, profitability. And then the last one is called market prospects. Market prospects is the ability to generate positive market expectations. Short way of saying that is attractive stock price. The ability to attract new investors by having a nice stock price or paying a dividend. Yeah, those are market prospects. Very well done. So yeah, those are the building blocks of financial statement analysis. As you recall, there are 4 primary financial statements. We have the income statement, the balance sheet, the statement of stockholders' equity, also known as shareholders' equity, also known as owner's equity. And then number 4, the statement of cash flows. For those of you who just finished Principles of Accounting 1 with me last week, you know that the statement of cash flows represents the cash coming into and out of the business for operating activities, investing activities, and financing activities. What about the other 3? The income statement, as we just talked about, represents the revenue, sales of the business, and then minus cost of goods sold equals gross profit, minus all of your expenses equals net income. Okay. Income statement shows all the revenue and expenses in the business, day-to-day operation of the business. A balance sheet, as you recall, which is probably the first financial statement we talked about back in Principles Accounting 1, represents the accounting equation. The accounting equation is assets equals liabilities plus equity. The balance sheet shows the balances of all of the company's asset accounts, liability accounts, and equity accounts. And then, of course, we have the statement of stockholders' equity, which shows us all of the changes that have occurred throughout the accounting period for the equity of the stockholders. This includes things like net income minus dividends paid, or shareholder investments, treasury stock, dividends paid, etc. Usually small things show up. So those are the four financial statements that we analyze in order to understand the financial health of the business. The fifth thing you'll notice on here says notes to the financial statements. These are actual notes that you type, like notes. It's like, oh, this happened, this happened. It tells the story of the business, the reason why certain transactions happened. Yeah, the notes. So we look at all of that information and we analyze it to better understand the company's financial health. We also internally, as a business owner or as an employee, we need to know where we stand against our competitors. Yeah, absolutely. So, especially if the company is publicly traded, like let's say we're Apple, I'd love to know how Samsung is doing. Okay, Samsung's publicly traded. I could get their 10K report and find out as an Apple person. Okay, so I can compare the two companies and understand the financial health of both. As an investor, that helps me to figure out which company I want to invest in. Yeah. Or as an employee, that makes me understand my competitor's behavior. Yeah. I can also look at that financial data and benchmark it against the industry's performance. Look by looking at the profit margins. And of course, guidelines. Yeah. These components are essential to look at when understanding the financial health of the company. A lot of different reasons. Yeah. So how do we do that? How do we analyze stuff? We typically do it in three different ways. We have what's called the horizontal analysis, vertical analysis, and of course ratios. The horizontal analysis helps us to compare the company's financial performance across the horizon of time. That's why I call it horizontal analysis. It's over the horizon of time. In other words, I can compare the sales, expenses, net income, and even the balances on the balance sheet from one year to the next. So I can look at 2022 for the year and look at my amounts on the income statement and on the balance sheet. I can compare that to 2021's performance. What it does is it shows me trend. It shows me the difference between those 2 years. I do it for 3 years. Heck, I could even do it for 5 years. It helps to show me the trend across time. Yeah, horizontal analysis. I'm looking at year-to-year performance and comparing that performance. So that's horizontal analysis. Vertical analysis is where I compare an amount to a base amount up and down the financial statement. Vertical, up and down the financial statement. Here's how it works. On the balance sheet, I express everything on the balance sheet as a percentage of total assets. Total assets is 100%. And so I take the amount of an item on the balance sheet and I divide that by total assets, multiplied by 100, to get the percentage of total assets. That's vertical analysis, is looking at it vertically, comparing it to a base amount. And then, of course, we have ratios. I remember the students from 201, Principles of Accounting 1, saying how much they loved ratios. Oh, Dr. B, they're my favorite. Every chapter you give me a new ratio to learn, I love it so much. Said no one ever. Just ratios, yeah. The ratios, of course, help us to identify at a moment in time the performance of the company for whatever it is that we're trying to measure. Ratios. So let me just drill down a little bit more on each of those 3 tools. First, of course, we'll look at the horizontal analysis, which I had mentioned is a comparison across time. We're comparing the company's performance from year to year. An example of that would be looking at the 2023 data, the financial data that I have, compare that to 2022, then to 2021. Okay. What it does is it helps me to identify trends, patterns across time. Yeah, looking at them horizontally. So how do we do that? We do this for the income statement and the balance sheet. And we do it for every line item on the income statement and every line item on the balance sheet. Again, it shows us the trends across from year to year. So how do we do it? We look at the change in dollars and percentage. Okay, I want to know how much the change was in dollars from year to year for each line item on the balance sheet and the income statement. I also want to know percent change from year to year. So how do I do that? Let's say we have 3 years of data that we're comparing. So the way I do it is I take the analysis period amount, we'll say the current year, subtract that from the base year. The base year refers to the oldest data found on that financial statement. Base year. It's the base. It's the oldest data we have. So, for example, let's say we have 2023, 2022, and 2021 of most recent data. My base year would be 2021. My analysis period will be 2022 and 2023. Look at the dollar changes. So I'll take the dollar change of net income for 2023, I'll take the amount of, we'll say 100,000. The base year was 80,000 back in 2021. So 100 minus 80 is 20. So that's a $20,000 change for the course of those 3 years. Yep. So that's just one of many examples that I can give you. And of course, we could take 2022. Our sales back then were 90,000. Compare that to base year 2021. That's a difference of 10,000. You see. So again, it helps us to identify the trends over time. So that's dollar change. We do the same thing for percent change. In understanding the percent changes, it helps me to understand how much things have changed over time. And the way that I do that is I take the analysis period amount, we'll say 2023, minus the base period amount, we'll say 2021, divided by the base period amount, 2021, and then imagine parentheses or brackets around that fraction. Then multiply that by 100. It gives you the percent change. Another mnemonic that I like to use in order to calculate percent change, you take the new amount minus the old amount divided by the old amount. It's a small mnemonic to remember percent change. So we look at the changes in both dollars and percentages. Let me show you what it looks like. Here we have a balance sheet for Apple. Okay, we have current year and the prior year data on a balance sheet. Most 10K reports will only show you 2 years of data on a balance sheet, 3 years on an income statement. So here we go. The balance sheet. So current year minus the prior year. Let's take a look, well, just to make things easy, let's take a look at total assets. Current year total assets was 338,516. The prior year's assets was 365,725. That's a difference of negative 27,209. Okay, interesting. So that's the dollar change. How do I find the percent change? It's new minus old divided by old times 100. So 338,516 minus 365,725 divided by 365,725 times 100 is 7.4%. Minus 7.4%. So, interesting. Just based off of looking at that single line item on the balance sheet, tells me that the total assets decreased by 7.4% from the prior year. Now, as a manager, I might be a little concerned by that. It's like, oh, our total assets went down. That's not very good. You might think that that's not very good. But then why would you think it's not very good? If you look further down, we see total liabilities also minus 4.1%. So you might say, okay, that kind of makes sense. So basically, we can see that these changes year to year are in line with what happened. You know, it's like, oh, our total assets are down. Yeah, but so did our total liabilities. So maybe we paid more loans off. Probably. That's what it looked like to me. There's a lot of things that you can read into in this data. Good. I think that this is very valuable stuff. So again, for horizontal analysis, new minus old divided by old gets you the change in percentage. New minus old gets you the change in dollars. Yeah. So that's how you want to calculate it. It's relatively straightforward with horizontal analysis. That's the balance sheet. We can look at Apple's income statement. Same concept applies here. Normally, you'd see 3 years of data on an income statement from a 10K report. So instead of it being prior year, you'd see a third column there, and it would say, whatever that prior year was, the oldest data, 3 years of data. And in that case, you will want to use the base year, which is whatever the oldest data you have is. The same concept. You apply the same rules to get dollar change and percent change as you did the balance sheet when it comes to horizontal analysis. Questions? Okay. All right, just making sure. Understanding the trends. It becomes challenging when you got a lot of years of data. So we use what's called a trend percentage when you have a lot of years. In most 10K reports, you're looking at 2 to 3 years worth of data at a time. But what if you're analyzing a wider range of years for a company? You're trying to understand, what are the long-term trends? Instead of looking at year to year, you would use what's called a trend analysis equation. This helps us to identify periods of data across multiple periods. Take the analysis period amount, current year, a year ago, 2 years ago, 3 years ago, divided by the base period amount. Again, whatever the oldest data you have. Could be 4 years of data you're looking at. So it would be the 4th year data. Times 100 gives the trend percentage. And here's an example of this. We see net sales over the course of 5 years. In order to find the percent trend analysis for the current year, we would take current year divided by 4 years ago, or the 5th year, if you will. That gets us the trend percentage. For example, for net sales, current year we have 260,174. Back in year 5 or 4 years ago, we have 233,715 net sales. So current year divided by the base year, year 4, year 5, gets us 111.3%. So that's trend analysis. We can also graph that to display the trends to investors, shareholders, managers, etc. And we can also do the same thing to compare competitors. Yeah, trend analysis. So that's for all horizontal analysis stuff. Let's jump into the vertical analysis. And this, again, vertical up and down. Vertical analysis is also called common size financial statement analysis. Okay. Vertical analysis is also called common size financial statement analysis. What we're doing here is we are looking at everything expressed as a percentage. Okay, so we take the analysis amount divided by the base amount and multiplied by 100. The base amount is very specific, depending on the financial statement you're looking at. For the balance sheet, the base amount is total assets. For the income statement, the base amount is total revenue. Those are your base amounts. So when we do this, we express everything as a percentage. Here we have a balance sheet for Apple. I express everything as 100% of total assets. So I take the analysis amount and I divide that by total assets for that respective year. So let's do that for the current year. For cash, my cash was $48,844 for the current year. My total assets were $338,516. So analysis amount, $48,844 divided by base amount, $338,516. That gives me 14.4%. Yep. I apply that same exact formula to every line item. You'll see that total assets is 100% because you're dividing total assets by itself. It's your 1 or 100%. Why? You'll also notice as you come down through liabilities and then eventually stockholders' equity, get to the line item that says total liabilities and stockholder equity. Now, as you recall, the accounting equation, assets equals liabilities plus equity. So liabilities plus equity should equal total assets. That's why you see total liabilities plus equity, it equals total assets. Yeah, because of the accounting equation. If that doesn't total up to 100%, we have a problem. Yeah, there's a problem. And we do that for each year. Yeah. This is very easily done in Excel. Yeah, it's just a matter of a couple formulas in Excel, and then you just drag and drop. Easy. Yep. If you ever want to learn how to do it, just ask. I'd be happy to show you. So that's the balance sheet. We use everything expressed as a percentage of total assets. For the income statement, we use everything expressed as total sales. Net sales. So you'll see that net sales is 100%. We take net sales divided by net sales, that's going to get you 100%. Cost of sales divided by net sales got us 62.2% for the current year. That's 161,782 divided by net sales, 261,774. We do that for every single line. For each. So why is it important? Why do we care about the common size financial statements? Great question. Somebody might come and ask you, hey, what's the change in net income over the past couple of years? I don't know. What do you do? You can tell them the percentage. All you do is run the common size financial statement analysis or vertical analysis. It's useful. It's very useful stuff. Now, when I talk to somebody outside of the accounting office, I like to show them charts and graphs. Why? Because people understand charts and graphs. When I look at this, I can look very quickly at this income statement graph and say, wow, Total cost of sales 62.2%. That's awful high. Is it? It might be. I don't know. It depends on what industry this is. So your net income is 20%. That's good. Income tax is 4%. That's okay. R&D 6.2. But you see what I'm saying. Being able to visualize the financial data makes a big difference to somebody who doesn't know accounting. You all know accounting because you took the class with me. But you want to explain those numbers that we just looked at to somebody outside of our class, they're not going to get it. So you'll pull that into Excel, and you'll create a dashboard of data. You'll create charts and graphs to help them to understand what it is that they're looking at. That's why data visualization is so important. And of course, the third tool that we use to analyze financial statements is ratios. And as you recall from Principles of Accounting 1, there's a lot of ratios. I remember some of you saying, "Oh, Dr. B, you're killing me with these ratios." Every single week, there was some ratios we talked about. And you're like, here we go again with these ratios. Yeah. Well, why we do it? They're important. They're important. It's a quick way for us to quickly check what's the financial health of the company. Boom, boom, boom. Here's a ratio. What does the ratio tell me? Well, what's the industry doing? I compare that ratio to the industry, or I compare it to competitors, etc. That's why it's important. So, just like we talked about earlier, there's 4 building blocks that we look at: liquidity, efficiency, solvency, profitability, market prospects. Within each of these, there's a whole bunch of ratios. Okay. Now, I'm not going to try to bore you to death with all of them, but we're going to go through them. Okay. Again, they're important to know. You've already seen most of them. I know that you have. We've talked about these in previous chapters back in Principles of Accounting 1. So don't be that surprised, because you'll probably know most of them. So liquidity and solvency. Liquidity and efficiency. There are 1, 2, 3, 4, 5, 6, 7, 8 ratios within liquidity and efficiency. There's probably more than the 8. But these are the most commonly used ones, right? So we'll quickly work through all of these 8 ratios. Again, I'm not going to bore you to death with them, so we'll go relatively quickly. We'll start with working capital. Working capital is very simple. It's the current assets on the balance sheet minus current liabilities on the balance sheet equals working capital. Very easy ratio. So what does it tell us? Why is working capital important? It tells us how much cash we have to work with. Yeah? Suggests the liquidity position of the company and an ability to pay its debts or to continue operating. Working capital, it's what's left over. It's the cash to work with. Yep. Working capital, very important ratio. The current ratio, this one's one of my favorites. Current ratio is very easy. We take current assets divided by current liabilities. Helps us to understand if the company has the ability to pay its short-term debt. Yeah. The higher the better. The higher the ratio, the better. Means it's stronger. Yep. Has the ability to pay its current debt. Anything over 1 is great. Anything less than 1, we got problems. The acid test ratio. Christy, earlier you had said that liquidity is the company's ability to quickly convert things into cash. Yeah, it sure as hell is. And one of the ways that we can measure the company's ability to do that is through what we call the acid test ratio. Cash plus short-term investments plus current accounts receivable. Current receivables. Divided by current liabilities. You'll notice that inventory is not included here. The reason for that is inventory is not that easy to quickly convert. I mean, yeah, I can have a fire sale and sell everything I got, sure. But it's not that easy. It's not that quick. That's why we don't include inventory in this calculation. But yeah, that's the S-test ratio, how quickly I can convert things into cash. Accounts receivable turnover. Tells me how quickly my customers are paying us. Simply put. We take net sales divided by the average accounts receivable. The word average in accounting means beginning balance plus ending balance divided by 2. The beginning balance plus ending balance divided by 2. That gives you the average. How quickly customers are paying us. Good to know. Inventory turnover. How quickly am I selling my inventory? Inventory turnover. That's what this ratio tells me. To find this, we take the cost of goods sold divided by average inventory. There's that word average again. Beginning balance inventory plus ending balance inventory divided by 2. Average inventory. Days sales uncollected. How many days it takes me to receive cash from my customers on their accounts receivable. Days sales uncollected. Okay. We take total accounts receivable divided by net sales times 365 days. Let's see how many days it takes for the customer on average to pay for their account receivable. Very important to know. Because remember, we talked back in Principles 1, we talked about this thing called the statement of cash flows. And when we talked about the statement of cash flows, that particular statement helps us to plan for the future. And knowing how many days it takes for your customers to pay you, very important in that planning process. Ooh, this one's good. The number of days sales in inventory. This tells you how long the stuff's been sitting on your shelf. Right? Days sales in inventory. We take ending inventory balance, divide by your cost of goods sold, times 365 days. How long it takes for you to sell through your inventory. How many days is sitting on the shelf. This is really good for planning purchases when the company is purchasing additional inventory. Knowing that number is really important. Otherwise, you might run out of stock. You don't want that to happen. Total asset turnover. This tells me how well the company is using its total assets to generate sales. To find this, we take net sales divided by average total assets. Again, the word average. Beginning balance assets plus ending balance assets divided by 2. Okay, so we got through the first building block, which is liquidity and efficiency. Now let's talk about solvency. I had mentioned earlier that solvency is a company's ability to pay its debt, pay all of its long-term debt, and go out of business, no problems. Okay, solvency. 4 ratios here: debt ratio, equity ratio, debt to equity ratio, and times interest earned. Again, you've seen all of these ratios before back in Principles of Accounting 1, pretty much at the end of each chapter. The debt and equity ratios, very simple to calculate. Here we take total liabilities divided by total liabilities and equity. Find the debt ratio. We need to find the equity ratio. The way you do that is very simple. Take 100% minus the total debt amount, the total debt ratio. 100% minus 73.3% is 26.7. See? It has to equal 100%. It mentioned back in Principles Accounting 1 that a company finances itself through debt and equity to equal 100% of the financing. See? Debt is, as it sounds, it's taking out loans, it's issuing bonds, it's selling stock. Well, that's the equity part. But taking out loans, selling bonds, that's how companies raise cash through debt. Then we have equity. The company might sell stock. They might have investments from the owners. Okay, that's equity financing. That's how the company raises cash through equity. Every company has a combination of debt and equity in order to finance the operation. See, that's why the debt and equity ratio is very important to understand. How much is being financed through debt? How much is being financed through equity? The debt to equity ratio is something that a bank would probably look at in order to understand the relationship between debt and equity, the riskiness of issuing a loan to a business. Yeah. So debt to equity ratio, we take total liabilities divided by total equity. Yeah. Very straightforward. This one under solvency is the times interest earned. Very simply put, tells us about the company's ability to make interest payments on its debt. Yeah. To find this, we take income before interest, expense, and income taxes, found on the income statement, divided by interest expense, also on the income statement. Now, one of my favorite areas, profitability. Company's ability to generate profit, right? Kind of like what Christy said earlier, the profitability is what's left over after all the expenses are paid. Yeah, that's basically it. That's profitability. Company's ability to generate a profit means that their sales are greater than their expenses. Typically, yes. very general sense. Profitability is a company's ability to generate adequate return on its invested capital. Returns, of course, based off of their sources of financing. 4 ratios here: profit margin, return on total assets, return on equity, and gross margin ratio. Start with the gross margin ratio. Company's ability to, measurement of the company's percent gross margin each dollar of net sales. Fancy word is saying, what do your margins look like? Gross margin ratio. We take sales minus cost of goods sold, divided by sales. Yeah. Obviously, the higher the better. Yeah. Profit margin ratio. Obviously, from net income. Remember, net income is representative of what's left over after all the expenses have been paid. Take net income divided by net sales. Yeah. That gives you your profit margin. Obviously, the higher the better. Yeah, definitely. Return on total assets. How well a company is using its assets to generate revenue related to profitability. Obviously. Take net income divided by average total assets. Average total assets, beginning balance plus ending balance divided by 2. Return on equity. Company's ability to earn income from common stockholders. Yeah, absolutely. We take net income divided by average total equity. Again, beginning balance plus ending balance divided by 2. That's how you get the average. And one of the last building blocks is the market prospects. We go through all 3 before? We went through... yeah, we did. All right. Yeah, so this is market prospects. Here we have 2 ratios. Yay, only 2. Price earnings ratio and dividend yield. Price earnings ratio, of course, is the ratio that measures market expectations for future growth. It tells us the future possibility of a company bringing additional value. We take the market price per share of stock divided by earnings per share. And of course, the last one is called dividend yield. Dividend yield tells us about the company's ability to pay a dividend to its stockholders. We take annual cash dividends per share divided by the market price per share. And some of you have asked me in the past, hey, Dr. B, do you have like a cheat sheet? Cheat sheet, that sounds so weird. Do you have a list of all of the ratios? Yeah, I sure do. And so do you. The summary of ratios. So these are all the ratios that we just went through. So here we have liquidity and solvency, efficiency and solvency, and then we have profitability and the market prospects. All nicely listed out on the 2 slides to keep your life nice and easy instead of having to go back and forth and try to find various ratios. Yeah, they're all right. Summarize and report the analysis. So we went through a process here, and I'm sure you saw that. We went through the 4 building blocks. We went through horizontal analysis, vertical analysis, ratio analysis, all in order to understand the financial health of the company, to help management to make better decisions, to help investors make decisions, to help lenders and other institutions that make decisions about this company. the end, we generate a report or a couple of reports of our findings, our analysis. And the way we do that is first we write up an executive summary, tells us our brief conclusions and results. We write up an analysis overview, which is a background about the company, the industry that it's in, and the economy performance. We look at evidence like financial statements, ratios, trend comparisons, the analytics, basically all the data. Evidence. We make key assumptions about that evidence and about the industry, etc. Identify key factors, which are looking at both quantitative and quantitative information about the general performance of the company. And the last thing we do is draw inferences. These include things like forecasts, estimates, interpretations of the results. So these are the things that we do when we analyze the financial health of a company. Of course, one of the last things I want to talk to you about is sustainability. Sustainability is a word that's oftentimes used to mean the overall stability of the company's operations in the future. Are they sustainable? Will they continue? The idea is that the company stays in business forever. We like to think so. Will it sustain its normal operations into the future? Sustainability. Okay. And in this, we look at possibilities, scenarios of things like what operations will be continued, what might be discontinued or no longer operating. We'll look at earnings per share, etc. All of these things are retrospective, meaning we look back and say, the company's currently doing this. They might want to think about stopping this or etc. Sustainable. And then, of course, example of that type of income statement, we see the normal operations up here, discontinued operations, and then earnings per share. So that was a lot of talking about analyzing financial statements. Are there questions about anything that we just talked about when it comes to analyzing the financial statements at all? Anything you could think of? We okay? We alive?
As right now, everything is okay
Okay.
for me.
All right, Danielle. Yeah, it's a lot. It's a lot to digest, but that's good. I'm glad that worked out. It worked out well. Anything else? Do we feel okay? Right. Okay, cool. So where does that leave us? So it's 7:30, almost 7:30. This course is scheduled to go to 8:50. I'm not going to hold you to 8:50. Yeah, silly. Normally, we have 2 chapters per week. The first week, I try to ease you into things. That's why we only have 1. But it's important to remember that there's more than just this chapter going on this week. You also have the QuickBooks stuff to do. So where does that leave you? Where does that leave us? Here's what we got going on this week. Number 1 is access Blackboard. Make sure you have access to the textbook. Then come down to week 1, under instructional materials. I want you to take a look through all this stuff. Right? Don't freak out when you see the 155 pages of the student guide for QuickBooks. We'll get to that. What do you need to do this week? Coming down here and Engage and Explore. You got two things for Engage and Explore. Number one, for QuickBooks, you have the QuickBooks Online Essential Training, which is a LinkedIn Learning certificate. So you need to make sure that your LinkedIn Learning account is set up. To do that, there's a document up here in the Start Here section that walks you through that process. Once you're set up, I want you to open this up, and you'll watch every single one of these short videos, starting with introduction and then going all the way down. You'll know you've completed that one video when there's a little green check mark. Okay? All of these need to have that little green check mark. All of them, including the conclusion. At the end, it'll show you a certificate. You want to download that as a PDF. And you'll come back to the classroom with that PDF. You'll upload that to this one under Action and Expression. It says QuickBooks Online Essential Training Certificate. You'll upload your certificate there. So that's task number one for this week. Task number two is a discussion board on Chapter 17, the stuff we just talked about, the financial statement analysis stuff. Okay. This is a little challenging, not terribly challenging. I want to read through this, okay? It talks about financial ratios. It wants you to share your thoughts on a specific financial ratio that you found particularly interesting or insightful. Provide a relevant reference to support your perspective. Like, for example, for me, I really like the current ratio. And the reason why I like the current ratio is because it tells me of the company's ability to pay its current debt. And as a potential investor, I want to know that the company has that ability because I don't like to invest in companies that cannot sustain operations, meaning they can't pay their current debt. So that's my ratio. That's why I found it interesting. And then I'll provide a resource that I found online about the current ratio. Yeah, that's your reference. And then it says, once you've posted your initial response, engage with your classmates, 2 or more of them. You'll respond to your classmates, say, oh, yeah, that's an interesting choice. I agree, or I don't I disagree, and why? Yeah. It's like, yeah, I don't know if that particular one's as important. Here's why. The idea here is I want you to engage in thought in the type of ratio you found to be most important. Why it was the most important? And engage with your classmates. Why do you think this? Well, why'd you choose that one? Make it engaging. Have fun with it. That's the whole idea behind discussion boards. It's not just, oh, Dr. B wants us to do stuff. That's not why I have this here. It's here because it helps you learn from each other. It's a whole part of learning. So that's the discussion board. I would like you to please try to have your first post in that discussion board on Thursday during the class time. Yeah, because it'll allow a few days for you to respond to some of your classmates. If you all wait till Sunday, that's going to be a very active discussion on Sunday night that you probably didn't want to have. So that's my philosophy on that. So That's item number 2 is the discussion board for this week. Item number 3, of course, is the PDF that relates back to item number 1, the training, the LinkedIn Learning training. You'll upload your PDF to there, that file. And then the last item, your 4th action item for this week, is the Chapter 17 quiz. Let me move myself out of the way, enter the student view. I want to show you the quiz. Obviously, I'm not showing you the answers. I'm just showing you the quiz. So, open up the quiz. You'll notice that there are 2 attempts. There are 2 attempts on every single quiz. Okay. So, if you start the quiz and you're like, okay, there's 10 questions, you'll notice it's a mix of true, false, and multiple choice. All right. Yeah, sure. Yeah, of course there's math questions. Why wouldn't there be? We just talked about ratios the whole day. So you'll answer these 10 questions. If you're like, oh, Dr. B, I didn't really do so well on that first attempt, no problem. Take it again. That's why there's 2 attempts. The highest grade of those 2 attempts will be accepted in the grade book. That same rule applies for every single quiz for each chapter. Yep. So those are the 4 things that you have to do for Sunday night. Obviously, I want you to use your class time on Thursday to do those 4 things. Yeah? Because we're not going to have a lecture on Thursdays for the most part, unless something weird happens. We'll have lecture on Tuesday nights, and on Thursday nights, that's your class time. I mean, yes, 3.5 hours to complete all the stuff for the week. I think you can do it. And I think it's a great way to balance things out for your schedule. Yeah, to make your life a little easier. Does that sound good? You all think that this is a good idea? Does it work for you? Yes, no, maybe?
Yeah, it worked for me.
Okay, all right, I like that. Awesome. Great. Well, this has been a good first class. We got about 7 more weeks left. It goes by fast. It really does. I mean, we're already halfway through the semester, so it'll go by quick. But hopefully you get something from it, and I'm sure that you will. I know that I am. I'm enjoying this so far, and hopefully you are as well. So, again, thank you all so much for your time today. I really appreciate it. Hopefully, things will go very smoothly, and I think that they will. If you ever need anything, you can get a hold of me. And I see Laquanda's hand up. Did you have a question? Comment? Concern?
Just one question,
Please.
because I would like to go through everything again. So I just wanted to know, was you going to post us a link for the YouTube?
Of course. Yeah. Oh, thank you. Thank you. Thank you so much for asking that question. Yes. As I had mentioned, well, I think when we first got started, all of these sessions are recorded, and I post them to my YouTube channel, and I provide the links to the videos in the announcements, and through email. Yeah. So that way you'll always have access to it. So yes, if for whatever reason you have to miss one of the classes, or if you got something you need to take care of, or whatever it is, you can always go back and watch it. Yeah, absolutely. I'll provide you with all that stuff. Question. So with that, again, thanks so much for your time tonight. I sincerely appreciate all of you and all of the work you will be putting into this course. I know it's a lot, but we will get through it, I promise you. And with that, stay safe, wash your hands, do the right things. If you need anything between now and the next time we meet or whatever, you can email me call me, set up office hours, whatever you need. Okay, I'm here for you all the time. That's my job, is to take care of you. So, thank you so much. Appreciate all of you. Have a wonderful rest of your night. Thank you. Thank you.
Thank you.
Enjoy
You
your night,
too.
Professor.